Hello guys, good day to you all and welcome to Crypto Cube Analysis. My name is Crypto Cube and this is my first analysis video this year, and I will be discussing about price action. This will be a very quick video just to buttress the point I made on Twitter today when I made a tweet about to become a price action guru and predict. I made a mistake here, or probably Twitter autocorrect. So to become a price action guru and predict directional movement easily, you don't need much. Just learn 3 important studies, which are market structures, basic Elliot waves, and Fibonacci. Combine this with supply and demand and entry triggers, and you got it all. So I won't be talking about supply and demand. I have some lessons on that. I may be making new ones, but not now. But I will be discussing market structure, Elliot waves, and maybe a bit of Fibonacci. Fibonacci is not a directional study or indicator. Rather, it is just a supply and demand. It can be used as entry trigger. So let's dive into it without spending much time. Which chart should I use? Okay, let me use this. Sorry for taking your time there. Okay, I want something clear because I do not want to go into this candle. So let's use this too. As we all know from the market structure lesson, the market structure is a series of higher highs and higher lows, right? Let me draw this again, make it bigger. Okay, right. So when we say this, we know the market is bullish, right? As in it is having a bullish trend or bullish market structure. So we can easily conclude that this price action we're seeing we can easily conclude that the market is in a bullish market structure or in a bullish state. So that is market structure. Once you have a series of higher lows which you can connect, sometimes they fit, sometimes they do not. Series of higher highs, new highs, and then you have series of higher lows, which are these lows, 1, 2, 3, like that. Then you assume your bullish bias until there is a change in this market structure, and that is by breaking this invalidation point which is here. That is when you say there is shift in market structure or break of structure, as popularly known as BOS. This is the major low leading to these new highs. This was the major highs when this high was made, and then we had this pullback. This pullback from this point, the pullback from this point to this very low is the correction or the pullback. And this was a place it found support or demand, but it just found support or it bottomed out at this point and then created these new highs. So for this low to be the bottom from the move from this high, it became the major low to break. And once this major low, which should be a protected low, once this protected low has price going down below it, now we have 2 things. We have a full break or we have a nut. Either way, we read market structures with highs and lows, right? So if price goes below these protected lows, that means the market has shifted in structure to the bearish side. Now, if price just makes a wick below these particular lows and then close above it, then continue to rally, then we will say that movement below the protected low is probably a stop hunt, or they call it deviation, or whatever you choose to call it. So it is likely that whatever supply that is above here might not hold, and as at that time it is good to take any short entry you want to take at that point with confirmation. But if you have a strong close, a strong candle close below this protected low, then by all means the market has fully shifted to the bearish side. So that is it about market structure. So note that you have these highs which was created by this low, and then we had a decent pullback creating this bottom or this low where we found support that led to the new and current highs. So that last low leading to that new high is the major low, and the major low is the invalidation point for this entire move. I hope you get it. Now that is for structure, right? Now let's go into the second one, which is Elliot waves. I won't clear this because I'm still going to use it. Now, what are the basic Elliot waves? Elliot wave tells us one thing, that we have 5 impulsive waves and 3 correctional waves. And the 5 impulsive, we can read it 1, 2, 3, 4, 5, and the 3 corrections, we read it ABC. And quickly, if you look at this left hand side, where we have this Elliot wave 2, just go through it, then you can see something. You have Elliot impulse wave 1, 2, 3, 4, 5. That is the impulse. Then you have Elliot triangle wave. That is complicated. That is no longer basic. Then coming to look at the correction, you have Elliot correction wave ABC. That is a 2. I've set them to make them be here. So that is a 2 you want to pay attention to. So Elliot wave says you have 5 impulse wave, which is 1, 2, 3, 4, 5, right? And then you have 3 correction, which is A, B, and C. Let me make this a bit thicker. Good. So which is, this is a impulse and this is a correction. So you have A, B, C, and 1, 2, 3. Sometimes the correction also goes like an impulse, like 1, 2, 3, 4, 5, because the market is just about confusing you so you can take a wrong trade. The market doesn't want you to always be profitable. They want to hunt you. They want to take your money. So you have to be smart now to see how they want to take your money or what they are trying to do to confuse you. Now, that is why I'm here, to guide you so that they cannot confuse you, except they confuse all of us together, which can happen. I can be confused. I'm not perfect. We are all learners. So back to it. Now, when you have this market structure, you can see the similarities. This is a market structure, right? Once you see a pattern like this, you know the market is in a bullish uptrend. And your Elliot wave, impulse wave, which means a rising move or a rally, is also comprises of 5 waves, which is similar to the market structure. So once you see this, you easily know this is also a market structure on its own. Now, here is the catch. Don't forget the ABC correction. Now, Elliot wave says we have subwaves like in, you know, when you do sets and unions in, is it mathematics or algebra? They are the same thing. So you have subwaves, waves, even subsets of a subwave. So it means you can have 1, 2, 3, 4, 5. I do not want this video to be long. Maybe 20 minutes max. It's almost 10 minutes now. So when you have 1, 2, 3, 4, 5. This is an impulse, right? With the corrections. Then this whole move becomes just one wave. It becomes just one wave of 1. Then you have, what's it called? A, B, C. And then this becomes the correction. Then you have another impulse. Now, let me show you on the market structure. So this is what I'm trying to say. This move from this point to this point on a particular time frame, like you can see this on the weekly, right? We have just this long move up. That can represent the move from this point to this point. And now the move from this top to this top seems to be the correction from this point to this point. I'm not exactly saying that for Gala. I have not studied it yet. So we have the first impulse, the correction, another impulse, another correction, then the fifth move. So in this move up, we have 5 impulse, which then becomes just one move. And then now we have this correction from this point. We have our A, our B, then our C to where we bottomed out. Then going from there, we have another, from the bottom, we have another move up, then move down, then move up, then move down, then move up. Let me try and change the color of this from blue. Should I use orange? Okay. So this, is it the same thing? I hope I'm not confusing you. Or is it too bright? Or it's okay? To me, it's looking like it's too bright. Let me change it a bit. Okay, let me just reduce. Perfect. I said I didn't know how to take time, but I'm taking time already. Okay, so this is it. I hope you can see it clearly on your side anyways. So we have this impulse wave which forms the first move from our market structure. Then we have the correction, the ABC, then another impulse wave. Then now we have from this point again the A, B, and C. Do not forget, this is a major low leading to these new highs. So that is our invalidation. Let me just bust like this. Once price closes above here, the market has fully changed structure. Trend has fully changed. If we have a wick below it, that is still a change, but it can be a stop point. And when we are stop hunting people, we just want to grab liquidity and continue running to the upside, shake out people. So when you trigger a wick below this, then it can be a stop point or a possible change of trend. That is why you need to watch for confirmation before taking a short entry. But if it fully closes, no doubt, take the short entry. If you have stopped that, the market condition is just blah blah blah, or it's just doing what it likes. So now what do you expect again on this move up? Another 5 impulsive move, right? So you have 1, 2, 3, 4, 5 to the highest, right? Good. Then if we are to remain in a bullish market, what will you expect? This low should be intact, right? Then we should have a pullback from this high to anywhere from this top to this bottom, but not going below the lows, right? Then continue to the upside. That is our expectation, right? So, and for that to happen, we might happen in ABC formation again, right? Now we have like our A, B, like our C. Or let me do it like this, like our ABC. Now, the market is trying to confuse you in this way. This is the bigger picture, but assuming this is on the weekly time frame, the blue line, let me make it even a bit thicker. Let's say the blue line, where can I make this thicker? Okay, let me do it for right. So the blue line, let's say that is our weekly time frame. Then the yellow lines, let's say that is what we see, or maybe daily or 4 hour. So on the daily, we are seeing 1, 2, 3, 4, 5. We are then forgetting, because of human psychology or human, how do they say it? We remember the most recent action. So I'm not doing this way. We remember the most recent action. So we are choosing, or our brain is choosing to forget this whole move, and then we are only factoring this yellow move to the upside. This 1, 2, 3, 4, 5. So this is also a break of, it's also invalidation. Yes, but so when you see a move from this high breaking this low and closing below it, you assume bearish bias. Fine, but your bearish bias, where do you think is likely to reverse? Some people will be expecting these lows. that because we have closed or broken a validation or break of structure on this mini zone or mini structure, then they expect here, which is wrong. We have this yellow move from this invalidation on this entire picture. So this is the origin of this move from here to this point. So this is the 1, 2, 3, 4, 5. So if we have a break of this invalidation from this point, then where you are targeting is at least this bottom here for take profit, or where you expect price to reverse at least. So when price does something like A, breaking this one, then it goes to B, you short it, and then it makes a C. And on the C, anywhere from maybe 50% mid range to the lows, it finds support, and then it continues to go higher. So that is the mistake people make when they're talking about directional bias. They forget the big picture. Even there are sometimes the market like to play wayo. Let me just say it like that. The market likes to play wayo a lot. So on the same time frame, you have this blue line. Like, let me clear this real quick. Time is far going. Let me clear this real quick, and then do it again. So we have something like this. The market structure, bullish, right? This is say 1, 2, 3, 4. Then you start having something like this. That is another one, another 2. Then you start having something like this. So what do you expect when you see something like this? So you have a long move up, assuming like from this point to this point. Then you have the correction. Then you have another long move up like this. Then you have another correction. Then it's making the 5th leg off, and it starts doing it in steps. Then people will say, once this low is broken, where is this 2 again? That once this low is broken, because this is the last low leading to the higher high, higher than this, they'll say then price is coming back to this. The price is coming back to this point. Oh no, my mouse, I think I need to change it. The price is coming back to this point. That is wrong. This is one thing, eh? Let me use my 1, 2, 3 now. Then this is the origin of the move itself. This is our 1, right? This is our 2. This is our 3. This is our 4. This is the last major low from this high. And once this high is broken by the move originating from this low, all this 1, 2, 3, 4, 5 becomes 1. So that is 1, 2, 3, 4, 5. So this is still our invalidation for the price to come back to this low. Once price from this side goes below this particular protected low, then we are targeting these regions. But if price go below this particular level here, it doesn't mean that we are coming down here. It means we are coming back to the origin of its own move. We have a structure here to write 1, 2, 3, 4, 5. So we can possibly have A, B, then C to this point, and then we start even going back in steps, or we can just use to go back like we have done before. So this are way the market try to confuse people, and when we see these things, maybe we are longing at this point and we are expecting higher rather than looking at anywhere from here or here. Because when you take the Fibonacci, this is why Fibonacci is not essential. When you take the Fibonacci, we are expecting a bullish move, right? So you see a step case like this, then you take your Fibonacci 2, and then you are expecting, what's it called, maybe the 50% range from these lows to this side, and you're expecting, some people expect the 50%. If this is 50% and we have this low around there, then you can start looking at that. But some people expect the 61.8%, which they call the golden ratio. Some people expect the 78.6, and some people, they even zone it from the 60, let me say 62, then to the 70. They zone it like this and expect price to bounce from here. So if price is going to bounce from there, that means this protected low is going to be taken out for the move, for just this leg up, right? So there you have something like this, and then another rally up, and this move down can happen in A, B, C. It can even happen in a straight line like this. It can even happen in 1, 2, 3, 4, 5. Then it can also start going back up in steps. So these are ways the market try to confuse you. And then using Fibonacci, it lets you know the entries or where you want to enter. And there is one catch with Fibonacci, and it is that if you are trading supply and demand, when you take your Fibonacci from the major low to the major high, then any demand that is below the 50% range, those are the demand you want to consider, because that is the point at which the market can start to reverse. And I've said it before that if you have a swing up like this, I expect a 50%, at least a 50% correction to make that swing a valid swing. And it's making it a valid swing because we already have a bottom. Let me remove this Fibonacci now, because if it retraces 50% of its move, then we already have a valid bottom here. Then it shows we have a valid top. But then there are other ways we can read tops and bottoms, that at times you just have a shallow move and continue. It can still be valid. But when we are talking long term and we are talking serious analysis, we want at least 50%. If it doesn't make 50% of this move, then the top is not in. That is a lesson for another day. So your Fibonacci in this case is just to use like an entry trigger. Why the market structure, I've explained it, the basic Elliot waves, I've explained it, that if you have a move up like this, like we have from this low to this point, if I go down into this Galasha now, we can see that it doesn't just happen in a straight line, it's a structure. Okay, I want to round up now, 21 minutes, so let me quickly box this move up. Let me box this move up. Let me delete this. Let me delete this. Then let me go to the 4 hour. Wow, it's far back. Okay, as you can see now, what can you see? This seems to be the top, right? So as you can see, okay, good. Let's start from here. So as you can see, what can you see from this chart? Remember, on the weekly time frame, it was just too long bar. Selected this already. It was just very too long bar like this. One long bar, then another one continuing. It was just 2 long bars before we start seeing red. Then, but on this particular, this is 4 hour, right? On this particular 4 hour, what do we see? We see a move up, a move down, a move up, a move down, another move up, another move down, then another move up, which gave a lower low, right? And let me even go to the daily time frame. Then we see again how it is on the daily. Okay, from here we can see the step move up, move down. Then we start seeing some move ups. We have from here, we have some move ups, then sideways, then another move up weak, then sideways again. These are sideways because they are not exactly good correction. Then another move up, then another move down, then move up. So that is the way it is. So one candle like this very green candle, it can be a lot of steps like this on another time frame. If you go lower, you notice that they are like this. But there are some cases where, oh, I think there is one chart, I'm not exactly sure which. Let me see, I think CRV. I'm not exactly remembering. I already passed time. I'm not exactly remembering. Okay, I think this is it. We have this move on CRV. We have a move from this to this point, to this point, to this point. Exactly, this is what I was talking about. If you can see this line, let me just do this first. Let me do this first. Okay, that's good. So if you can see this low at this point, this low here, this low was the one that broke this high and led to another highs, right? Then we had a wick below of this low. This was a invalidation low, right? Then we had a wick below it from this move down, no close below it. Then what happened? We hunted people, shook out people, then price came back all the way up and then triggered the upside liquidity as well. But when the upside liquidity was triggered, what happened? We created another main highs higher than this size from this low. So this particular low became the invalidation, and this particular high became the new high to break for continuation of bullish rally. So everything that happened between it, they are range. Now look at one thing I want to point out. This was a previous high, then price came from this low, then it started moving in steps. Now let me get the steps. So we have, let me not use this week, let me just use from here. So we have from this low, we have this high, right? Then this low, then this high, then this low, then this high. So what happens when this breaks? People believe the market is now bearish and they start to short. Fine. Then when they are shorting, what happens? This is correction, right? This is our A and this is our B and this now is our C. That is supposed to be hit. And if I was to take this one trade based on supply and demand, I will be taking from this point to this point like this. So from this point or in the middle or below, but my stops will be below, somewhere around there, mid range of this zone. So calculator, my stop should be somewhere around there. And then what are we seeing? This zone itself has been stop hunted. We now have a week. Let me remove this one quickly. We now have a week going below this invalidation. We have not gotten a close below of it yet, so we have hunting going on, and this is a possible trend change. That means we have this high now to this low, and this becomes our invalidation to break for a bullish bias to resume if we are now assuming bearish bias on this coin. But if you have a full close below it, then you should start looking for short, either by deploying Fibonacci and then taking the 50% or the 60% or the 70% range. And remember, supply and demand, anything above or below the 50% which is here, and then you have a zone here you can take, you have another zone here you can take. So that is how to combine Elliot waves, market structure, Fibonacci, supply and demand with any other strategy at all you want to use. So as at this moment, for this particular coin, it is bearish, but we still have the likelihood of running the highs like we did here, where we broke this low with a wick and then we went ahead to close above the high, making new highs. And then we did that in steps to confuse people. Yeah, you can be right at times. This low was taken out, but this is ABC. This entire move that broke this low would not have happened if it wasn't for what happened on BTC. So that is where crypto is a bit different. BTC influenced altcoins a lot. I wish BTC were to be normal and sane and not following indices market like Mumu. Sorry to use that language. This move, breaking this lows, might not have happened. So that is it about the tweet, and that is it about market structure, Elliot wave, basic, Fibonacci, basic. I have a lesson of Fibonacci that is highly extensive, where I talked about Fibonacci retracement itself, trend based, no, not this one. Where is it? Okay, Fibonacci retracement and trend based Fibonacci extension, also with Elliot waves. I have an extensive video that you can check it out. So if you have not subscribed to this channel, you can subscribe and share, so anytime I make this video you can always get a notification, and also learn on how to be a price action guru. Thank you for watching.